last time you and I sat down, we were talking about your capital raising. It's been a couple of years. I'd imagine you are thinning out the capital that you had raised. What's your plan around your capital base? Do you intend to go back to market? Are you still speaking to the DFIs, or how will it play out now?
So now we disburse all the funds that we raised in the capital markets last year. So we actually wanted to go back to the market last year. We couldn't.
For the yield environment.
For obvious reasons. Now we are planning to go to the market next year. 2026. We have, I think in our view, we think the markets are beginning to have a correction. At the moment, the short-term rates are single digit, which is great. If the same trend continues for the medium-term bonds, then certainly by the end of the year we'll have more clarity, and that way then we can go to the market next year. When we issued our bond last year, we issued it at 90 basis points above a government instrument, which is a benchmark. So the rates were around 11.5%. We expect that the rates are going to come down to maybe around 12% by the end of the year. That's for, say, a 5-year bond. And that way, we should be able to go to the market with that kind of rate. So we are actually preparing to go to the market for that. The other option that we are considering, and of course, we do blended finance.
Correct.
Is that we expect to raise more funds from DFIs. The nature of funds that we expect to raise will be slightly different from what we raised initially. And that's because, of course, sustainability is now a key issue. We want to do green. We're encouraging a lot more of green housing or green mortgages for that matter. And that is the kind of discussions that we're beginning to have with the DFIs. But the most fundamental thing is we will still continue with blended finance, and that's the approach we want to take. So we tap capital markets and we do DFI financing at the same time.